Welcome. I'm Neal Gorenflo, co-founder of Shareable. I've written about the frontiers of resource sharing for over a decade, from tool libraries to new democratic organizations. I've been invited by my friends at Common Trust to host a series of conversations about their new book, Assets in Common, that proposes an ambitious yet pragmatic pathway for scaling the shared and steward ownership economy, and backs up this vision with deeply researched case studies. The book's full title is Assets in Common, Stories of Business and Community Leaders Remaking the Economy from the Ground Up. It's just been released, and today is episode 2 with Chelsea Robinson, Charity May, Jay Standish, and the latter two did the bulk of the case research, and we're going to go deep into these case studies that back up this thesis that Zoe Schlag and Derek Razzo sketched out in episode 1. And roughly that thesis is that the shared and steward ownership movement can better scale by connecting businesses through shared services and assets. So welcome to the conversation, y'all. So let's just start with quick introductions, just name, title, affiliation, and your role in the book project. Full bios will be in the show notes. So Charity, let's start with you.
Thank you, Neal. Hi, my name is Charity May. I'm the principal and founder of Sacred Futures, which is a regenerative systems design practice. And I had the privilege of being a senior researcher and co-author on this new book, Assets in Commons.
Hey guys, I'm Jay Standish. My background is primarily as an entrepreneur. I'm just coming off of a 10-year tour of duty doing a startup as a founder, running a shared living real estate platform. And as far as this project goes, also a senior researcher and co-author of the book.
Hey everyone, I'm Chelsea Robinson and serial entrepreneurial career. And my role in this project was really project lead, project management, and also ended up being the editor, which was a wonderful role to play.
Yeah, did you write the introduction as well, Chelsea?
Yes, participated in the co-authorship process for sure, but really my role was trying to bring all the threads together from across the different case studies that we looked at.
Yeah, and the first question goes to you, Chelsea. So I shared a short one-sentence version of the book's thesis, but I wanted to hear from the editor. You're the only one that's looked at the whole thing all together, at least in detail. And so I wanted you to elaborate. What is the thesis of the book?
Yeah, so this book really comes from a starting point of many people across the United States are really aware of the potential and opportunity of steward ownership and shared ownership structures of many kinds. Many people are also very aware of the possibility of things like community banking and shared finances. And what we really wanted to do was take all of that a step further and take a strategic look at how to pull some of these tactics together into forms that allow for greater resilience and competitiveness. So what we really wanted to set out to do, and again, this is 6 months of research even before we started writing this book together, right? And so at the beginning of that whole research process, we're really looking at where does that competitiveness come from for these models that include a lot of alternative ownership methodologies and different financing methodologies? And we really found again and again that it was the connectedness between different assets, different resource bases, different, whether it be companies or real estate portfolios or investment portfolios, that connectedness was part of the story of competitiveness. And so the book really anchors in this narrative of what you can do when you put assets in common.
Yeah, what I was really getting from the book too is just the idea that through these shared assets and services, small and medium-sized shared ownership and steward ownership companies can compete with the big guys, can get those scale advantages through collaboration instead of just pure scale. For me, what I see in that is just an alternative to the typical way of doing things. There is no alternative, right? There are many alternatives, and this being one way that we can organize our economy, and one that's more democratic. So I want to go to Charity and Jay and find out, why did you guys get involved in this project? Both of you joined Common Trust specifically for this project. And so what inspired you to do it? Was there a particular experience that sparked your interest? How did you find yourself in this work. Jay, let's start with you.
Like I was mentioning, my last major project was a real estate company that managed community living spaces. And something we always wanted to do was to figure out how to create a shared ownership model for our properties where the residents could co-own the real estate they lived in. So they were owners, not just tenants. And long story short, as a startup, you try not to solve too many problems at the same time. We were busy solving capital problems and operations problems and community problems. We learned a lot about community and collaboration and the human dynamics of how to do projects together. And so I just thought that this was an amazing opportunity to do some deeper dive research into both the legal and financial side of things in terms of what are the innovations out there, as well as the operational and human aspects of deep collaboration.
Yeah, I can see where that curiosity might lead, Jay. Maybe there's one of these types of enterprises in your future, huh? Yeah, and Charity, I wanted to hear from you. Yeah, could be, right? Charity, how about you? What led you into this?
So I've been on a journey of, I consider myself a designer first and foremost, but my background has been heavily in the financial sector. I worked in the conventional investment banking world where hundreds of millions of dollars were circulating through a very small subset. And not getting to the access to capital was a question that I was also always wrestling with. Who gets access to capital? Who gets to decide how that capital is moving through the system? And holding the weight of what is transpiring in between relationships between us as humans and the non-human world. We are facing environmental crisis, a lot of different crises, injustice, all of those things. And so I have been on a journey of asking the question, why? Why are we doing things this way? And then following up with the how. How can we maybe reimagine something a little different, a little better? Being really passionate about connecting with like-minded folks who are also wrestling with those questions and challenging the systems that exist and looking for ways to build something a little different. Very much attracted to this project because it was very, and even timing-wise, in alignment with a lot of the work that I already was interested in terms of leading into, okay, how do we pull financial capital in different investment structures? Can we think differently about community governance in terms of how those decisions are being made and for capital being invested? And then how can that actually translate to healing landscapes and healing relationships between humans as well? Yeah, it was an exploratory journey of wanting to find creative solutions and ideas and bringing those to other builders. And so now I'm excited about the doing, getting to the doing.
Yeah, I can see that. Yeah, and there's a couple of things in what you said that resonated with me, just about imagination. I think part of the book is about expanding our economic imagination, our imagination for what's possible in society and our economy. And just, you said healthy landscapes. I was like, yeah, let's do that.
It's critical. We're connected.
For sure. Yeah. Yes. So each of you researched a selection of case studies. And now let's dig in. I want each of you to think of a case study and go into what this organization does and how it's structured and how it might support the thesis of the book. Let's start with Charity.
Sardex is a company based in Italy in a small region called Sardinia. It is a complementary currency and mutual credit system. Sardex has developed a digital platform to allow for small and medium-sized enterprises regionally based in Sardinia to trade, to buy and sell goods and services without using money, without using euros, because the money in and of itself is actually the goods and services themselves. The platform provides credits up front, Sardex credits up front for those businesses to use. And the whole idea is promoting circulation.
Yeah.
It's promoting not accumulation. They had this idea around the 2008 crisis where Their ability to access liquidity, their ability to get financial capital from the banks was restricted, was severely restricted. So they began to really experiment and try to figure out what could resiliency look like outside of our conventional monetary system. And basically asking the question, can we redefine money? Which I love that question. And maybe create something a little bit different. And so that's where this idea of the Sardex unit came through. But just to hone in on two of design components, they removed the speculation that does exist in our monetary system by stating that one Sardex unit equates to €1. So there would, if you are a trader on Wall Street, and you have euros, there's a market for people trading different currencies because there's the possibility of arbitrage. But by stating that one Sardex unit is equivalent, so naming that value, you're effectively removing the speculation away from that component. The second component was really no accumulation. And the idea with money, and the reason why we may be more motivated to accumulate our dollars or accumulate our money, is because there's interest, or you are being paid to hold your funds in a trust or in a bank account, right? So there's an interest rate that's paid to that. They said there's no interest that's going to be tied to the Sardex unit, because we really, again, it's all about promoting circulation and ensuring that one Sardex unit goes all the way around and is traded however many times between different types of businesses to effectively reach the value of zero, so that relationship is fully complete. I could nerd out on the monetary creativity related to that, or monetary policy, but it's also rooted very much in relationship and trust. The founders at the very beginning, they had to convince small businesses that this alternative model would work, it would be a benefit to them. So there was a journey of building trust, and it has grown amazingly and is one of the most successful complementary currencies, because in history, in terms of still being around, still growing and expanding as well, but it being enabled by trust in each other, building relationships. So the model is actually a membership-based model where the small businesses become members to participate. So a lot of learnings from that particular case study, one of the really fascinating ones that I wanted to highlight here.
Yeah, and Sardex, that's really interesting. I've heard of it. I had just learned some new details. What I'm getting, Charity, is that the Sardex is a way for the small and medium-sized businesses, which may have trouble accessing credit, that they can use this to exchange goods and services among each other. Is that correct? Am I getting it right?
No, that's exactly right.
I know we want to talk about a number of case studies, but I wanted to just point out one of the things that's amazing about Sardex and shows up as a theme across many case studies is B2B services and B2B connectivity. And I really want to highlight this because I feel like a lot of people in this extended community and the kind of ecosystem that's passionate about alternative ownership models and alternative finance, we're well educated in the opportunities for individuals to band together and create opportunities together, whether that be in cooperative business structures or peer-to-peer lending. These things are well understood. But what we've been really focusing on in this body of work is going one level up into the kind of infrastructural connectivity layer between entities. So I just think this B2B currency is such a fascinating example of B2B services.
Yeah, because small, medium-sized businesses often struggle competitively with larger firms who leverage all kinds of capital, financial, cultural, political, otherwise, to get advantages. This is one way, and it's not that complicated, really. It's not like high tech necessarily. So it just seems like a good opportunity for small, medium-sized businesses. And just like you said, Chelsea, just backs up the thesis of the book. So Jay, same thing. Tell us about a company that really interested you, and what do they do, and how they organized in a way that's different is an example of the thesis of the book.
Sure. So a good example is called Carpet One, which is a flooring store, and they have about 4,000 locations actually around the world. Most of those are in the US. And the way that Carpet One started is a couple entrepreneurs who owned 2 or 3 carpet stores regionally each were starting to realize that they had real problems competing with the big box stores on price. So like Lowe's and Home Depot, we were always undercutting them in terms of selling carpet, hardwood flooring, any kind of flooring material. And they were very active in their industry. They were the sort of president of the Industry Association of American Flooring Retailers, that kind of thing. And they spent a year doing research, talking to their peers, fellow sort of independent flooring owners, and saying, hey, we're looking at a franchise model perhaps. But a lot of the people that were already in franchises were like, it's very expensive. I have to send them a lot of money every year. I don't get that much value out of it. I don't really want to do that. And so what they came up with is essentially creating an upside down franchise, in the sense that all of the independent stores co-own a central brand and supply chain and operations brain called Carpet One. And that brand is something that people can move to a new city and say, oh, Carpet One, we bought from them last time when we lived in Indianapolis, and it looks like a big box store and it has a national presence, but it's actually a network of small, locally owned independent stores. And what the central sort of brain does is it is able to do bulk purchasing of flooring material. So they can get much better prices because the entire country is on one kind of purchasing relationship with the suppliers. And so then they're able to compete on price with the big box stores. And then they also have a shared brand, which is Carpet One, but they also do advertising. So they might produce a television commercial that's white labeled in terms of location, and then each location can take that commercial and repurpose it to their local environment. And then they have an internal operations consulting, best practices, how to run a carpet store. So they trade notes and have an operating system that they share. And it's been so successful that they've branched out to other industries and spawned, rather than carpets, bicycles. And these are all separate entities now, but they were so successful that they've expanded to other industries.
Yeah. So they're just taking the template and moving it to different verticals, it sounds. Yeah.
Yep. Yeah.
Yeah.
Carpet One is really an example that comes up around shared services between businesses. And I think, Jay, as you articulated, it is both a brand cooperative, but it's also a purchasing cooperative. And there are a number of additional shared services that they've been able to layer in as they further and further develop that ecosystem and include more and more in-house. And I just think that's a big theme in our work, is the shared services between entities and how you can unlock more together. I think when we're talking about competitiveness and we're talking about how can these smaller entities out-cooperate some of these larger entities in the business ecosystem in the United States, especially as we see more and more aggregation and consolidation under monopolies. This was just a really competitive strategy that we saw time and time again, is business-to-business shared services, or going under one roof in one way or another, so that they could band together and benefit from those shared assets, essentially.
Yeah, and I want to go back to you, Chelsea. You lay out some principles in the introduction to the book that I take are derived from the book's team's analysis of the case studies. Yeah. What principles did you find across these varied examples of shared ownership in action?
Yeah, thanks, Neal. We definitely saw a lot of commonalities and patterns across different case studies. Actually, right from the beginning of our work together as a research team, we were looking at what kinds of case studies might reveal some success factors for some of these kinds of processes. And some of what I've articulated in that introduction that you're referring to is some of those success factors or some of those patterns that we tend to see over and over again. And so some of those are just one example or two or three. Let's see how we go here for time. But one of them is conscious consolidation, which is just a phrase that we came up with to describe bringing multiple entities or multiple assets or different parcels of land or whatever it might be under the same roof in some way that is a conscious and deliberate effort to consolidate with values at the forefront. So what we see a lot of is consolidation in the economy where small actors are swept up by the bigger ones, and that's a very kind of typical extractive modality of these smaller ones being brought into more monopolistic structures. And so what is that conscious consolidation process where some of these smaller actors can come together with the benefits of aggregate scale and the resilience that is afforded to having more assets under one roof, but doing so in a way that isn't about extraction, is actually about sharing benefits. And so I think with some of the examples that we've already heard and plenty more, that just gives us some illustration of what that conscious consolidation sort of principle looks like. Another one that came up time and time again was shared balance sheets. And this was actually an inquiry that we had from day one, which was how can we put more things on bigger balance sheets together so that they can have the upside benefits of liquidity, of mitigating the downside risks of an economic downturn moment. How can entities borrow from each other in moments of strife? A lot of our case studies were taken from contexts where people were going through a form of hardship, whether it be the Sardinia example of the 2008 financial crisis or different examples from around the United States or around the world that we drew upon. Many of them come from a context of economic strife. And so what we saw is this kind of banding together and introducing connective infrastructure to help create resilience in a time of strife where people could experience more interdependence between their entities in order to overcome the kind of ups and downs of the financial markets that they were participating in at that time, and not necessarily have to turn to extractive capital sources to gain that resilience at a time when then that would further compromise their ability to serve their stakeholders or their purpose over the mid to long term.
Yeah, that's a great part of the book because you just brought up two different, you call them success factors, but there's like, how many, like 10 or 11 of them, right?
Yeah, there's plenty. And there was a point that Charity made earlier about monetary policy and the design of money itself. That's one of the factors. We noticed that in these internal marketplaces, these sort of designer markets between entities, that there's so much sovereignty happening around what the currency and what the exchange and the value of that exchange is, that it's almost like we're popping up our own little mini monetary policy environment where we can design what the value means to those players. So there are so many of these different points, whether it be a more technical point like a shared balance sheet or a more cultural point. Another success factor or principle that we found was a form of radically pragmatic leadership, really humble, really hands-on. The leaders of a lot of these examples tend to be people who have rolled up their sleeves decade on decade to help their stakeholders and their places, and have done so really with just a willingness to get things done, find those win-wins, and figure out how to build these kinds of institutional arrangements in the context of quite challenging regulatory environments as well. So these are people who are looking for those sort of ways to weasel together all these different win-win solutions within often a really challenging environment and not necessarily a liquidity-rich environment either. And so again, another success factor on this list that you're referring to includes these more soft factors or these more cultural factors, which are just as much part of the success as the technical factors as well.
Yeah, that makes sense. And also I love this phrase you guys coined, conscious consolidation, right? I like it. It's meme-worthy. Yeah, and I was going to ask you, Chelsea, more about the importance of building connective infrastructure. I think you've gone into it really well, but it made me think, what is the benefit on the ground for frontline employees? Why is it better for them?
So if we're putting this into the context of small to medium businesses, that's one way of utilizing these ideas. Another way of utilizing these ideas might be a community leader who's managing a community real estate project, or even a religious leader managing a church real estate environment. These ideas are applicable to a lot of different contexts that aren't just small businesses. But with your question about how does this benefit people who are inside companies that might participate in some of these systems, I think there are lots of ways of benefiting employees. And I think probably Jay could also speak to some of the examples here too. But what we see is just greater resilience. We also see this in some of Charity's case studies in terms of Mondragon and Keiretsu. We see greater resilience for any entities that are participating in connective infrastructure. So again, with this sort of connective infrastructure and infrastructure for shared ownership, we're talking about financial infrastructure, financial interdependence, we're talking about legal interdependence, we're talking about things like cross-shareholding, we're talking about this enmeshment and interweaving between these individual modules of assets, right? And so if an individual person inside one of these assets, whether it be an employee or a manager or anything like that in a company, they're going to experience a smoothing of the challenging ups and downs of their business environment, especially when there is a mutually agreed upon way of supporting businesses that might be in a network environment together. Networked enterprises is also a phrase we use a lot in the book. How can these networked enterprises support each other through those ups and downs so that there might be less layoffs, there might be more transparency about how those ups and downs are handled, open book policy around, okay, maybe one business on one side of the state isn't doing that well, but as part of the network, they get the opportunity to draw from a central fund to prevent layoffs during this quarter, whatever that might look like. So there are plenty of examples of that, and I'd also be interested as well, Charity and Jay, if you had any specifics from some of your research that really illustrates that.
Thank you, Chelsea. I think there are, as you mentioned, so many incredible themes and consistency related to how these, whether it's an enterprise or a community group or a region, trying to figure out how they aggregate their resources and allow it to support each other. And I'll briefly name one that you just referenced, but in the Keiretsu case study, which is a Japanese concept that is essentially a loose affiliation of enterprises coming together through a couple of different, what we call ties, network ties, cross-shareholding, as Chelsea mentioned. There's also a social connection between the presidents and leaders of the various enterprises themselves that come together more for social reasons, less like our U.S. board of directors, where there's a requirement to meet and report and to make particular decisions. This is more really about building social cohesion so that when there are times of distress and maybe economic conditions are not great and there are decisions that need to be made that are impacting one enterprise versus another, the decisions that need to be made to support the network as a whole, there's already continuity there. There's already a relational bridge that is there, less time needed to convince and to build trust because that work has already been made as a core component of that tie. And the Keiretsu model is very deeply rooted in history and rooted in that place. And I think that's one thing that I wanted to name and highlight as well as just I would say humbling and incredible learning that a lot of these ideas and ways that people are organizing and networking are not necessarily new.
Right.
Maybe applied in a different sense, but there's an incredibly rich heritage in the desire to share, the desire to collaborate, and the desire to aggregate resources and redistribute them for a broader subset, to a desire to take on the burden for a business to take on a burden for another business for a short period of time, for example, by being able to provide financial resources, legal resources, or even leadership in times of distress. And the rich heritage, and we name a couple of other case studies in the book as well that are probably more grassroots oriented, of people, peer-to-peer lending and the savings pool concept and rotating savings and credit associations, again, very grassroots, person to person, but growing out of that all the way up to a Mondragon, which is this one of the largest cooperative networks and Karitsu, which is a very large corporate interaction. Again, the fundamental value system of thinking about how do we benefit the collective, benefit the whole, and navigating the economy. What do we need to build? What do we need to create to do that is a really powerful learning that has come out of bringing all these stories together.
Yeah, it's kind of basic lesson. If you're a business, you don't need to go it alone. There's many different ways that you can collaborate with other businesses. It goes against at least the business culture in the United States, which is bootstrap, self-made, do it on your own, and really downplaying all those connections and all the different various forms of capital that can help a business be successful. Yeah, and Jay, I wanted to go to you on a similar thing too, because one of the critiques that you hear about cooperative businesses is that they struggle to compete with traditional corporations. How would you respond to this concern? What are the competitive advantages that shared ownership models leverage?
I think that's a really important question right now in our society, as we've seen decades upon decades of consolidation and wealth concentration and larger corporations getting a share in the economy in general. And so I think shared ownership and steward ownership is a model by which small companies can band together to compete with larger companies. And a good example of that in terms of thinking about the scale is Oberon Cooperative, which is a holding company of multiple businesses that are held together as a group, and that entire group is owned by its employees. And so this is an example where they have some home health companies, they have a logistics, 3PL, third-party logistics, shipping company, and they have it's called a professional employer organization, a PEO, which is like a back office HR organization. So they have multiple companies, and the profits from those companies are distributed back to the group of employees. But the interesting thing about Oberon is that instead of, for example, the home health company, those employees don't just get the profits from their company. They pool and distribute all of the profits from all of the companies back to the entire group of employees across all businesses. So if
that's interesting.
COVID happens and it hits the home health services really badly, those employees still have some financial resilience. It's almost like portfolio strategy. It is portfolio strategy, actually, but it's being applied to employees in regular companies who wouldn't otherwise have access to diversified assets and a diversified portfolio.
Wow. That's really interesting because it's, like you said, a portfolio strategy. But if you're a worker, you're not putting all your eggs in one basket and tying your fate to just one company. You are aligned with multiple companies in this network. And that's just another way. Chelsea spoke to this too about the way these types of organizations better provide job security or improve job security. That they're more resilient in downturns. But here's yet another way that you improve job security. So that's really interesting. And Cherry, what could adoption of this kind of strategy, this network businesses, this connective tissue that we've been talking about here, what does this mean for rural areas? Any area could probably benefit, but why might it be especially important for rural areas?
Some of the work that I do in rural economic development and partnering with other organizations, all of the questions that we've been talking about are exactly the questions that are coming up. How do we rebuild infrastructure is a really specific one, and bringing different partners to the table, whether that's from the federal government, the state, regional economic development agencies, in supporting the small businesses, which in a lot of cases are family-owned operations. I won't go into detail, but we highlight one case study called the Industrial Commons, where through cooperative enterprises, for-profit, worker-directed for-profit LLCs, and for-profit LLCs and governmental agencies being able to work together to pool capital for reinvestment And now the Industrial Commons, which is based in Morganton, North Carolina, they're envisioning an innovation campus. And that's not something you hear about.
Yeah,
in
didn't they
rural
get a big
context.
grant for it too, right? It was like $10 million.
Yes, they
Yeah.
received a $10 million grant from federal dollars that were coming in, but also the nonprofit and community was also successful in working with their state officials to get funding set aside in the appropriations budget for economic development in that region. And I don't think that would have been possible without the relational connection, but also the storyline around economic development
Right.
and being able to preserve jobs within that location and extend it beyond the current generation as well.
Yeah, there's a lot of excitement around industrial commons, and I was stoked to see them get that grant. And I'm looking forward to watching that whole thing unfold there.
Yes, it's very exciting and a lot for other communities to learn from as well.
You need this kind of ways of strengthening local economies, including this kind of, shared and steward ownership and this connective tissue of shared assets and services that can strengthen small and medium-sized businesses. But you also have to keep that process of industry consolidation in check too, right? Or these big corporations just become so powerful that there's just this asymmetry that can't be overcome.
Yeah, I think some of the examples that we've just touched on really illustrate some additional themes in the work around regionalism, place, our relationship with place, but also the role of citizenship and how economic thriving and prosperity for local communities also enhances people's participation in the outcomes of their places. Because if they have that time and energy and that capacity to be able to focus on the bigger vision, when I think about the innovation center that's being really pioneered by the Industrial Commons, it's happening because of a level of collaboration that was actually not only between business entities within the Industrial Commons network, but also between business and civic entities in that region and the wider group of stakeholders that all are working together towards that shared purpose of that regional revitalization and that shared economic prosperous future for those people in that place. And I think another sort of overarching thread that we haven't really touched on in this episode, but maybe we can pick back up in other ones, is this theme of shifting our whole economic logic from extraction to reinvestment. And I think a lot of these apparatuses that we're talking about are really designed to do that, whether that be at that small scale of supporting members of a community to be part of a savings pool, like what Charity mentioned, or whether that be at the larger scale of supporting quite large businesses. But this is not a niche thing. This is not all just tiny little entities scattered to the wind. Some of these businesses that we're talking about and some of these entities that we've outlined are significantly profitable and are significantly and consistently reinvesting in the thriving of their communities and their places. And what is the purpose of those businesses is something that would be great to expand on in future episodes too, because I think a lot of what draws people around these solutions is recognizing that business is definitely a part of economic development, and pooling assets and creating liquidity together and things like that is economic development. But economic development in and of itself is almost like a point of leverage for the restoration of our landscapes, the restoration of our community, cultural connectivity, and mutual reliance on one another.
And our civic culture, right?
That's right. So it's all connected, and this isn't necessarily just pigeonholing business, and it's not necessarily just pigeonholing like creating greater profit sharing for more people, although that's part of this. It's about a sort of more sophisticated strategy to walk us towards a different economic logic altogether, if that makes sense.
Yeah, and logic for society as well, too, from individualism to more collaboration, more cooperation. And what you were saying reminded me of something Eleanor Ostrom said, who studied the commons and won a Nobel Prize for her work. And she talked about democracy with a small d, and that any time people got together and made a decision outside the family, that was practicing democracy. And you can do that, and also in your work life, and build the practices and the mindsets of citizenship in the workplace. And I think that's super important and underemphasized in our society. Yes, so we're getting towards the end here, but I wanted to have a quick roundtable on leadership. What role does leadership and culture play in these shared ownership arrangements?
I think Chelsea mentioned earlier about being humble, and I think that humility is being humbled by the path that leaders are signing up to take, because the purpose and the vision that they see of what is possible is so great, and the holding on to that vision of we can interact in our economy in a different way. It is possible, even though everything else around us is saying it's not. So yeah, I wanted to just reemphasize that component of the humility, but being humbled by the process and approach. But there's also
and the commitment too. The commitment too. Charity, you got to be super committed. It's not like this flighty thing that you're going to pop in for 5 years and then leave. This is for some of the people innovating on this frontier, and also not a frontier because it's been around for a while. It's like a life project, right?
Life project, and in service of and in service to. Yeah, you're not necessarily guaranteed the exit opportunity that other entrepreneurs might get of developing an idea, raising capital, and seeking that strategic buyer. These leaders are in it for the long haul in terms of what can I start? What can and maybe coming in at what can I stabilize, and then how can we continue to grow this? So there being leadership at those various stages as well. But it is also, I think also not for the faint of heart.
Yeah.
Because you will be misinterpreted, misunderstood, because it's like speaking a different language as well. And so a lot of the energy is the translation to the existing structures and systems.
Thing that we found common to all of these leaders is they're thinking about people other than themselves. And coming from a background in entrepreneurship, being a founder, raising money, a lot of the logic and the business strategy and the financial structures and the legal structures are all oriented around individuals amassing personal financial return in some way or another. And so I think what we're seeing is people who are focusing on different things. They're not totally sacrificing their own personal finances in the process. And in some cases, some of these leaders of steward-owned companies actually sell the company into steward ownership and get a perfectly market rate return, and they do get an exit and a significant financial event, but that's in service to other people gaining from the process. And a lot of the collaboration is in service to the local region or customers or other players and stakeholders that these leaders are thinking about. And there does seem to be a genuine care and concern about their fellow community members and thinking about where that region is going to be in 30 years. There's a company in upstate New York that converted to steward ownership, and part of the reason they did that is that that company can never be sold, and it never can leave that region. It can, but the employees would never sell it out of the region because they all live there. And so it's a way of creating a job guarantee rooted in place to say, hey, this company is not going to get offshored or moved to another state that's offering better tax advantages or something like that. These jobs are staying in upstate New York, and they're high-paying jobs, and that over 10, 20 years, it's bringing a couple $2 billion in economic activity to that region. That's the kind of thinking that these leaders are doing. And once you've sold your company or you've made quite a bit of money, because these are cash flowing companies, at a certain point, if you have $10 million in the bank, $20 million in the bank, do you really need to make another $50 million by selling it to a private equity firm or a publicly traded corporation? Or could you do something really interesting that impacts real people positively on the ground? And so I think that's the sort of mentality that is driving leadership behind some of these projects.
Yeah, I really like that kind of win-win-win thinking. The business owner wins, the employees win, the region wins. Chelsea, anything you wanted to add before we wrap here?
I would just say that if anyone's really interested to deep dive on this topic of leadership and culture, Charity and I did put together a whole chapter around this in the book. And Charity, I think you spoke so well to it around the nuances of humility and leadership and how they play out when people are really just pursuing their purpose with such immense determination and gumption. And also, Jay, just to reinforce your point about this hybridization of leadership not just being about one thing, it being about achieving this sort of like broad base of holistically positive outcomes for the purpose of the assets themselves, like what are we trying to achieve here, and always being driven by that question of what are we trying to achieve here, and continuously and iteratively generating pragmatic answers to that question that benefit more people than just themselves. But it's not pure martyrdom, it's not just all self-sacrificial, and I think those paradoxes are really interesting. And again, Charity and I do dig deep into that in that chapter, so I would definitely invite folks to take a look at that if you're interested in more there.
Thank you, Chelsea, Charity, Jay. As expected, this was a great conversation. I learned some new things, and I really enjoy that. So this concludes episode 2 of our Assets in Common conversation series. In our next episode, we'll explore part 3 of the book, which is more theoretical and conceptual, and explore the future of this movement. We'll have a mix of folks from the book team to get into this. And so I'll see you then. Thanks for joining us.